an early cycle thing because it's so interest rate driven. But interestingly, because I think we are moving, I'm bullish at bonds, although I think they may correct here for a little bit with stock market. But ultimately, in the next 6 months, I think you could see the 10-year down below 3%. And if you get that, you'll get the mortgage rate down under 6 or maybe 5.5. So you could get one last kind of splurge of people who think they missed it and they're glad rates are down again and jumping in. But you're not going to get the volume of activity you had at the top, a year or two ago. And then, when the bust hits, I think, at least in the States, you could see 35% hit to the prices. And, I know UK's got its issues, so, you guys will get hit too.
In that regard, do you think the US is less vulnerable or more vulnerable than the world outside? There should be a natural demand. We were speaking to a cycle expert, Phil Anderson. He was saying that because America is kind of the place to live, it will always have underlying demand for the dollar and for people to want to buy there in a crisis. Perhaps you could say with the UK law that that's one attractive element of living in the UK or having a business in the UK, but we're certainly not as pro-business as America is. And I've struggled to think why we just can't sort that out. But in any case, who do you think is going to weather the storm the best and the worst? If we could give a kind of
you guys need a Maggie Thatcher. That's what you need.
Maggie Thatcher.
But yeah, I think my thesis has been in terms of the global bust that because of what happened in 2008-9, our banks are in better shape than they were going into 2008-9. Obviously, we were forced to get religious subprime and all of that. So our banks are better capitalized this time around. That doesn't mean they're not vulnerable. They're vulnerable. But I think the European banks, the Canadian banks, the Australian banks, the Asian banks are probably where we're going to see the bigger problems this time. It'll spill over into the U.S. banks because it's obviously a small world, but I think it's very possible. From a financial standpoint, it's very possible that the EU is where the biggest troubles are. Maybe Asia, but EU's got. I think the banks are just more vulnerable.
The EU reminds me of a joke made by Professor John Hearn, who said it's like 2050 and the EU will be long gone and like tumbleweed, and the UK will still be trying to furiously negotiate its way out.
Yeah, I mean, with regard to the euro, do you think this is masking a lot of problems within the euro area? And when they put the euro together, everything was going up. So you had a very stable, sunny outlook for the markets, and we're in a bull market. And of course, there's been big moves in between, but that was the environment. And there was so many countries that thought that they were going to get rid of their currency and were part of the euro, but they were also going to take the euro. Like Poland, for example, they were always going to take the euro. The Czech Republic didn't take it, but the Slovakia did take it, and there was a break on it when I think people saw the problems that it caused by kind of having one interest rate for very diverse economies, and they've managed to keep this together much longer than I actually thought it would ever last.
But at the expense of a functioning democracy, because you look at politics in Germany, and they're now trying to outlaw parties that they don't agree with. It's a real scandal.
Yeah, it's when you look, basically you take away countries' ability to respond to their economic crises. Spain, Italy, wherever. Everything's kind of driven by what the EU wants and what the ECB wants to do, and it takes away your flexibility. I think as the bust hits and as things get rough, it's going to be hard to hold that together. I think. And especially when you look at the trends in the world. Obviously, Trump, Merloni,
Malay.
Malay. We are, and certainly France came close. We are seeing a move to sovereign nations again, a move back to saying, we want to get away from this globalist approach.
Mm. And what percentage, if that's kind of a fair way to put it, or feel free to ignore it if you think it isn't, of what percentage chance do you think the euro would actually break up and people will go back to countries will go back to their 2.0 version of their previous currencies? Because I think they're not allowed to. So the Italians can't go back to the lira, but they could call it something similar.
New lira.
The new
It's
lira.
always hard. It's always hard to imagine something as big as that, right? But if I'm right about the global bust, I think the odds are a lot greater than you might think that the euro's not going to survive.
Mm.
And I'd say this is a problem caused by the EU itself, because I remember back in the day, back in the 90s, working at Paribas and trading in ECU bonds. If either of you guys remember the ECU.
ECU, yes.
And the problem is with the whole EU fantasy in economics is there was never ever a plan B. It was always assumed it would be this sort of monolithic, currency that would never ever need an escape route. And if you've got that degree of hubris, you are guaranteed to have problems at the end of the day.
Sure. Yep. And you talk about bureaucracy. You just don't, when things start getting rocky, you don't need the bureaucracy in the way saying, oh, we're going to hold this together and we can't do this and you can't do that. I just think people are fed up with it. So, the bureaucrats may be able to hold it together, but I think there's a higher percentage than you might think of things breaking apart.
When the euro was put together, one of the arguments was, look at America and look at how well the states work. But the thing is, Americans feel like they're Americans. There is no,
and they have a 200-year history of integration.
There's no desire for Germans to want to pay Greek pensions,
Right.
And vice versa, and so that doesn't make sense. And I think on top of that, as you were also alluding to, the cycles seem to be suggesting that people are, even within the states in America, as we saw through the pandemic, there were different responses, and it's almost like there's more fragmentation out there than there is a desire to unify, and those things go through trends as well.
Yeah, I think it's a trend in the right direction. It's very good news that we're moving back towards individualism, back towards sovereignty, and away from globalism. And I think that's at all levels.
Do you think that do you think there's do you think there's a chance of civil war in America, given how fractured the two sides seem to be?
I thought there was more of a chance of that before Trump got elected. He's going to town, and I think I don't know what the numbers are, maybe 55% versus 45 now. But it used to be, the MAGA side was 30% or whatever. I think an awful lot of people in the last year have moved over to saying, yeah, this, we're starting to see the light. We see the media was lying to us. We see the Democrats were all about themselves and trying to basically, if Trump, we dodged the bullet. If Trump had not gotten elected, I think we were looking at a one-party system in the U.S. It was that far along that if they had, the lawfare and everything that was going on, they really truly were destroying this country and what we stood for. And I think doesn't mean we're out of the woods or that this is a long trend that's totally we've reversed this and it's going to stay like this going forward. Who knows? But I think Trump was an important election, probably the most important election in my lifetime, more so than even Ronald Reagan. And the left isn't going away quietly, but I think Trump and his team have thought this out. They're not coming in like they did the first time and not having a plan.
It wouldn't be a fair fight if you had a civil war now, because all you'd need to do to demolish the left would just be to deliberately misgender them, and they would just collapse spontaneously.
So value stocks are coming into favor. Do you think that this is something that will transcend the crash? So will be a good move into and beyond the crash?
Yeah, if you think about what my bigger picture long call is, it's basically rates down here. So I think this last move, what I call the final parabolic move into a top, will probably be broadly based. So both growth and value will play, both large cap and small cap will play, because you're going to have rates moving down. That'll benefit growth, but you also have with the move towards small cap, the move towards things. It's unusual. Typically, in a final move to a top, markets narrow, right? Normally, you narrow into a very narrow group of stocks, like the Nifty 50 back in '73. But I've said for a while that I think this last leg of this one's going to be a broader move, and it's because of that. Because I think bonds are going to play, so that helps growth. But also the economy is going to be intact, and the earnings are going to be intact, so that helps value. And you're also getting, I think, the Fed will be, you'll have wind at your back. The Feds will be easing because inflation's moving towards that 2% target, and as a result, people will start looking over the trough and saying, okay, the cyclicals can play. So I think you get that into the top, and then you get the bust and what I'm calling an 80% bear market in the bust, and coming out the other side in the next recovery cycle. I think it will be, value will lead. It'll be basically a very big industrial / commodity cycle. And if you think about what the bust is going to do, it's going to hit housing hard. It's going to hit stock holders hard. So the wealth effect is going to get driven to the floor. The consumer is not going to be the driving element of the next cycle. If the market drops 80%, you can have the S&P triple or quadruple coming out of that. So a cyclical bull market, but it won't get back to the highs of this year. So if let's say we top out at 7,500 and you drop 80%, that's 1,500. And again, I'm not trying to say it's going to precisely do this, but and so you could go 1,500 to 6,000, which would be a quadruple, and you're still short of 7,500 by quite a bit. So I think we're at a secular bull market peak. The start of the secular bull market was 1982. It was driven by disinflation through most of that 40-year period. And the next cycle is going to be more like the late 70s. It's going to be, oil could go to $500 between, I think oil's going to 30 in the bust. From 30, it could go to $500 by the early 2030s. You're going to have inflation. That's going to put a real crimp in the lifestyle of the consumer. He's going to be just trying to get by. So the real strength of the market in the post-bust era is going to be industrials. It's going to be commodities. And of course, what we've done is for 20 or 30 years, we've rationalized capacity in commodities down, right? It was not a commodity world. We kept shrinking commodities and made them more efficient. And then all of a sudden you get this 20 trillion from the Fed and proportionally similar from every central bank in the world to deal with the bust. You will ramp up demand in a hurry, a couple year lag maybe, but by 27 or 28, demand for commodities is going to be through the roof. You can't ramp up capacity. You've shrunk the capacity of the commodities down in copper and aluminum and steel and everything. And yet demand around the world is going to go through the roof, particularly in the US as we reshore. The only thing it can give in a period where you have limited capacity and huge demand ramp up is price, and price goes through the roof. So you get a few years where commodities make money hand over fist, but it doesn't last because the central banks can't print more money. They're going to be tightening, trying to deal with this. So you get a short cycle. I'm guessing the cycle will be over by the 2031 or something like that. So you come out of it, let's say in 26, second half of 26, and you're done by 2031 or something like that. It's a short cycle. If you're in the right places, you can make a whole lot of money, but it doesn't mean it's across the board. There'll be places in tech, obviously, with AI and things where there'll be growth through the roof in certain areas, so they can make it. But it won't be a tech cycle like we had this time, where rates were generally trending down through most of the tech cycle, and growth was moving up. In the next cycle, it's going to be very much a cyclical growth driven by price.